What, in your opinion, will cause Tesla stock to spike? Unquestionably, Tesla stock has underperformed over the past year, and it looks like this trend will continue. However, there are still several you wouldn't want to miss this. If you're still positive about the future of the top electric vehicle manufacturer, James Stevenson, a well-known Tesla shareholder, analyst, and member of the Tesla Twitter community, recently posted a lengthy thread on Twitter expressing his optimistic outlook for Tesla in 2023. Stevenson wrote, "I hate to disappoint people who might think that Tesla's recent deep price cuts would rack up any prospects for 2023 earnings growth. Record quarterly deliveries and earnings are still coming in 2023. He then continued posting a number of tweets in her Twitter thread with graphs and explanations of his perspective that as a result of Tesla slowing down the wave of deliveries, Q3 and Q4 deliveries both fell short of analyst estimates. The current price reductions guarantee that Tesla will continue to establish quarterly records for 3C deliveries. According to Stevenson, Tesla produces the two best-selling luxury cars in the world, the Model 3 and the Model Y. Model 3 sales are increasing, but not as much as Model Y, whose production is expected to surpass 3,000 vehicles per week at both of Tesla's recently opened factories by 2022. In a later tweet, Stevenson provided a chart showing the production and delivery figures associated with the aforementioned chart, indicating that the Austin and Berlin plants have increased production significantly since they began operating at capacity. According to Stevenson, from mid-2022 through 2023, the solid red line production will surpass the dotted white line deliveries as ending inventory levels continue to rise and the average cost per delivered car will increase, leading to higher profitability. Additionally, the Tesla analyst stated that in terms of profitability, investors prioritize earnings growth. At a conference, Tesla CEO Elon Musk predicted that the company's fully autonomous vehicles would be available by the end of 2022. Martin Vika, head of investor relations at Tesla, also mentioned that the company was on track to release supervised, fully autonomous vehicles within Musk's projected timeline. Based on this assumption, my forecast is that Tesla will grow earnings over the next several years by making full self-driving so compelling more buyers will pay for it at higher prices before when Tesla extensively distributes fully autonomous driving towards the end of the year. Drivers will still need to pay attention to the road and adhere to safe driving procedures, as Visha explained. Supervised FSD is essentially supervised autonomy, meaning the driver is still an active participant in the car's mobility. Going back to another chart in the previously mentioned Twitter thread, Stevenson presented his updated chart that shows where Tesla's average dollar of revenue comes from, as well as his forecast for 2022 Q4. Vita hinted that drivers who do not drive responsibly with FSD would lose access to the service, similar to how drivers in the FSD Bay program lose access to their advanced driver assist systems when they drive irresponsibly. He added that the Tesla collects more data from interventions, meaning the company learns more from drivers who actively correct full self-driving movements. The Tesla energy business has notably seen significant progress in 2022 amidst economic uncertainties that caused Tesla stock to drop. In light of this, Stevenson sees substantial revenue growth from the Tesla Megapack, fires energy for their grid reliably and safely, eliminating the need for gas peaker plants and helping to avoid outages. I'm forecasting Tesla Energy to see substantial revenue growth from Megapack XL as the new factory in Lathrop ramps up and 2023 incentives kick in. During the Q3 earnings call in October, Tesla stated that each unit can store more than 3 megawatt hours of energy, which is sufficient to power an average of 3,600 households for an hour. Elon Musk, the CEO of Tesla, stated that stationary energy storage is actually rising at a rate of 150 to 200% annually, which is significantly quicker than the growth of automobiles. The company's energy division, Tesla Energy, installs solar-powered roofs and power walls in Megapacks, among other stationary energy storage devices. According to its shareholders' letter, energy storage deployment reached a record high of 2.1 gigawatt hours in the most recent quarter. While semiconductor challenges continue to have a greater impact on our energy business than our automotive business, Tesla revealed some details about the new record energy storage deployments in Q3 that increased by 62% year over year to 2.1 gigawatt hours, by far the highest level we've ever achieved. This level of growth was accomplished despite the fact that demand for our storage products remains in excess of our ability to supply them. In response to the increasing demand, Tesla is ramping up production at its dedicated 40 gigawatt hour Megapack factory in Lathrop, California. Chief Financial Officer Zachary Kirkhorn, Tesla said during the earnings call that the company achieved its strongest gross profit to date, primarily due to record volumes of its Megapack and Powerwall products. Tesla's earnings per delivery are world-class for any automaker, let alone an EV maker, and that strategic price reductions by Tesla will halt the growth of earnings per delivery in 2023. But earnings dollars will rise as a result of increased deliveries. He went on to say that decreased expenses per delivery are the result of the Berlin and Austin operations ramping up, which is why earnings per delivery aren't falling by more. Additionally, Fremont has the highest cost per vehicle and is losing share of the worldwide mix. It becomes more difficult to deliver every vehicle before the end of each quarter, the more vehicles you produce each week. In a different graph, Stevenson demonstrated how the wave's end impacts Tesla's quarterly completed goods inventory level. In addition, Stevenson pointed out that although revenue per vehicle declined in 2021-2022, Tesla's automotive gross margin, excluding regulatory credits, increased throughout 2021-22, which he believes is difficult to achieve. He thinks that while Q4 will see a decline, revenue should increase throughout 2023. In a more thorough chart, Tesla analysts demonstrated how revenue has increased over time. In HF4 of 2019, I predict revenue to reach a record high of over $25 billion higher than for the entire year 2019. In the tweet, he stated that some Tesla believers like to assert that since operating expense figures for Tesla aren't rising quickly enough, it must be a hoax, mostly because of CEO stock compensation. In a subsequent tweet, he said, for Elon's 2012 stock compensation exercise, Q4 2021 in particular had a one-time payroll tax of $340 million. The remainder of the Twitter discussion from on a related side, some analysts are sure that Tesla stock is the best option for 2023 following the worst year ever in late December bears some interesting comparisons. Stevenson provides numerous charts of his forecast, in addition to a number of more complete drawings of Tesla's deliveries, revenues, and earnings. Ben Callow, an equity researcher, lowered his price target for Tesla from $316 to $252. Then Kellogg hailed Tesla as the greatest investment pick for 2023 investors. 6 analysts had already lowered their price estimates for Tesla shares, but the objectives are still significantly higher than the stock's current price, and most of them had retained buy and outperform ratings. According to Callow, investors shouldn't worry too much about declining demand in the first part of 2023. According to the analysts, Tesla can enhance car leasing and provide more powerful incentives among other demand levers. As electric vehicles continue to gain market dominance, Kylo stated that Tesla is in the best position in the automotive industry. Market Baird's positive outlook for Tesla shares is in line with that of Wedbush analyst. Dan Ives, who has long been optimistic about the EV powerhouse, since Elon Musk took over Twitter, Tesla bull has frequently and recently voiced his concerns about the CEO. According to analysts, the billionaire statements and the news cycle surrounding him are hurting Tesla investors. Musk has interacted with people from a variety of political backgrounds on Twitter and made political remarks. The analyst added that it would be easy for us and other bulls to give up here and see the near-term headwinds as too fierce to overcome for the stock to work in 2010-23. Ives called Musk's Twitter endeavor a soap opera and a fiasco that is causing brand deterioration for Musk and Tesla. Last week, Ives cut his Tesla stock price target to 175 from 250 while maintaining an outperform rating for the shares. Despite this, Ives remains optimistic. Ives has not mentioned that roughly 70 of the recent sell-off in Tesla stock is attributable to the response to Musk and Twitter. However, he wrote that any additional strategic blunders by Musk will be closely examined by the financial community and will negatively impact shares. In general, Tesla stock is still one that should be closely monitored, particularly since it is still too early in the year to make any significant predictions. Don't forget to subscribe to this channel to receive updates on Tesla stock.